Hi friends, this is Rahul Jain, and in today's video we are going to discuss how to assess if an IPO is priced right. A study by Outlook India identified 5 IPOs that got listed way below their issue price in 2023. And here is a list of IPOs from the first half of 2024 where the listing price of the IPO was lower than its issue price. So not all IPOs fare well in the market. Here are two kinds of analysis that you can do to get an idea about what could be the right price for an IPO. First is discounted cash flow, DCF. DCF analysis plays a crucial role in evaluating initial public offerings by providing a fundamental valuation method. Underwriters and investors use DCF to estimate the fair value of the IPO firm, which is an ex ante estimate of the market value. DCF considers the time value of the money and risks using a selected discount rate such as the weighted average cost of capital, WACC. This helps evaluate the investment's potential returns and assess the firm's ability to generate cash flows. Second is comparable company analysis, CCA. This involves comparing the company going public with similar publicly traded companies. You look at metrics like the price to earning ratio, price to sales ratio, and enterprise value to EBITDA ratio. To sum up, effectively evaluating an IPO requires a thorough understanding of its fair value through DCF and a comparison with similar companies using CCA. However, it is also crucial to consider market sentiment as it can heavily influence IPO pricing and performance. By integrating both quantitative and qualitative methods, you can make more informed investment decisions. That's all for today's video. I hope to see you in the next one.
Investment in securities market are subject to market risks. Read all the related documents carefully before investing.